Hello and welcome to our webinar today. Before I commence, I want to acknowledge that we're meeting on, I'm meeting on Larrakia country and acknowledge the other beautiful Aboriginal land that everybody else is meeting on. I make the statement on what was and what will always be Aboriginal land, that sovereignty was never ceded. And I acknowledge all elders past, present and emerging. So I want to thank you for attending the webinar. This has actually been a COSS national initiative and we're really pleased to be able to offer it to you. We would not be able to offer this to you without the incredible generosity of Professor David Gilchrist from the University of Western Australia, who has offered to do this for us at no cost. And as I was chatting before, I said, we're really good in the sector at talking about social policy and social outcomes and getting really good outcomes for vulnerable communities. What we sometimes need is some assistance in terms of the accounting standards and how these work. For those of you who don't know Professor David Gilchrist, he's an economic historian. He's also a chartered accountant, and he's probably the best person in terms of expertise to be able to help us to understand what it is that we're eligible for in terms of the JobKeeper payment. He's got a PhD in economic history, but if I had to go through his resume, I'd take up the next 35 minutes. Suffice it to say, he's got plenty of expertise. He's also accompanied by the research fellow, Thomas Emery, who we're very lucky to have, and he will come on the panel to help answer those questions. For those of you, apparently we've got 381 people registered, so there's clearly an interest in this, which is great. And the other thing to let people know who weren't able to come or who have people in the sector who wanted to come but couldn't make it is that this will be available to you as part of a webinar to watch on the live recording. So any attendees who missed out can do that. Also on the call is Brendan from ACOSS. So I might hand over to Brendan now to discuss some of the housekeeping.
Thanks, Deborah. So this Zoom is organised as a webinar rather than a meeting. So that means as an attendee, you won't have video or audio options, only the speakers and technical support have that. You can participate in the Q&A sessions by pressing the Q&A button at the bottom of your screen. And any questions that we aren't able to answer during this webinar, we will be sending out written answers. Feel free to put in as many questions as you'd like. You can upvote questions that you want answered, and that'll help us give us a sense of what you think is most pressing to be answered. You can also comment on others' questions. If you've dialed in by phone and aren't able to send in a question with the Q&A function, you can send any questions to Thomas Emery at thomas.emery@uwa.edu.au. And if you have any technical issues, just use the chat function and I'll answer you that way. Any questions, please use the Q&A button. Any technical issues, use the chat button.
Thank you. I'll get underway. I'll just share screen so that people can see the slides that we're using for this session. And before I do anything else, I'd like to also say thank you very much to ACOSS for supporting this and giving us the opportunity to provide this information to the sector. I think it's really important that we're able to turn these things around really quickly, and also to acknowledge Tom Emery, who has been a fantastic supporter of this process and has worked around the clock to make sure that we've got a good presentation for you. The other thing I would say is that at the end of the presentation, we do have two things that I think will be important for people. The first thing is a slide with links taking you to relevant and updated information from various sites, so do use that. And secondly, both Tom and my contact details, and we'd be delighted to get any questions or comments. So not just questions about how this JobKeeper payments arrangement might impact your organisation, but also getting feedback on the kinds of issues or problems that you might be having so that we can help to inform the advocacy process as well as inform our presentations going forward. The final thing that I would say from an introductory perspective is that at the end of the day, I think there are three things that organisations should be thinking about in order to approach JobKeeper payments. And the first thing is that you need to obviously be aware of all of the requirements of this program from an eligibility perspective. And we will step through those requirements. But the other thing that I will do is step through some principles that I think are really important to help your organisation make the decision about whether you're eligible, and even if you are eligible, whether you want to pursue this particular opportunity in terms of JobKeeper payments. And those principles are quite critical, I think, because the third thing that I would say to you is that it's absolutely critical for you to not only document what your ultimate outcome is in terms of your decision to pursue or not pursue JobKeeper payments, but at the end of the day, also document the decision-making process. In other words, the principles you've used to land on whether or not you as an organisation are eligible for this particular payment, and then how you decide to go forward. I'll come back to these high level points throughout the presentation, but I do think it's critical that you document these processes. Before I get into the main part of the presentation, the other thing that I'd really like to do is to just go through a notice that I'm obliged to go through so that people are on the same page in terms of what the purpose of this webinar is. Firstly, it's important to remember that this presentation is intended for general information and it's not financial advice. We're not entitled to give financial advice, but also we don't know enough about your organisation to give that advice in any case. It's also not specific to any particular organisation, and it's up to participants to determine how your organisation should proceed in the context of the JobKeeper allowance or any other aspect of the general information provided in this presentation. And I'll make some comments and general responses to questions put, but you need to work out whether that applies to your organisation. So what you might need to do in order to progress your organisation's adoption of this particular program is get some advice from your auditor or your accountant, or perhaps some other appropriate professional person, including perhaps your solicitor, to make sure that your organisation is going into the right or making the right decision in relation to this program. I think that is also really important on two fronts. One, the situation is changing very rapidly, so some information here might be nullified by future changes in policy as it's refined. Remember too that some of the comments that I make have been announced but not necessarily legislated, and so you need to not only take into account what has been announced, but you need to take into account whether or not those announcements have been legislated and are actually enacted as regulation or legislation. And then thirdly, we don't know what kinds of post-fact investigations or audits might be undertaken by the Commonwealth Government on organisations that actually access JobKeeper payments. And so from that perspective, you do need to get that advice, but you also need to make sure, as I said before, that you document your decision making. Now, in terms of today's agenda, I guess building on my comments, I want to look at essentially four major areas. Firstly, I'll discuss the scheme, talk about what the scheme, how the scheme works, how eligibility works, and so on in general terms. Very probably many people in this webinar today will have a good understanding of the scheme at the highest level. The second thing I want to do is have a discussion around some principles, and I mentioned in my earlier remarks, I think it's really important that organisations don't only approach eligibility from a legal perspective, but also consider the principles about how they make determinations of in relation to things like what is income, what is government income, and so on. And we'll talk to those shortly. I've got some risk considerations that I think are important to raise and to talk through. And then there are some frequently asked questions that we'll round off the webinar with. I intend to speak for about 40 minutes, and then we'll have 15 or 20 minutes for questions from the audience. And so hopefully we'll be able to deal with most of the questions during that time. Okay, so before we get to the scheme itself, I think there are some further key points that have needing to be responded to, because these have been raised around the sector over the last couple of weeks as JobKeeper has become more and more, I guess, considered by organisations. First and foremost, the scheme is a pump priming measure. What does that mean? It means that the government is very keen to get as much money into the economy as possible to do three things essentially. Firstly, to ensure that those people who are no longer in work are able to continue to pay their mortgages, their rent, and meet their bills. The second is to make sure that the economy doesn't take a nosedive. In other words, we're trying to ensure that confidence and consumption continues in the economy, notwithstanding the significant restrictions that have been placed around organisations undertaking their work. The third thing is to make sure that at the end of the day, so once the crisis has been superseded, or once we've learnt to manage or live with COVID-19, that the economic structure itself is maintained so the economy can pick up where it left off and we can continue on. In other words, it's really important to understand that because this is a pump priming measure, it is incredibly important that government gets as much money into the economy as quickly as possible. And therefore the legislation and the regulations are being nuanced and changed on a daily basis, but at the end of the day, we're probably not going to get every single question answered in people's minds, and not everyone's going to be able to do it the right way. I think the other thing to be aware of is that different outcomes will be felt by different organisations. And so one of the things that keeps coming up in discussions around the sector is whether or not it's ethical to apply for JobKeeper if your organisation is not in need of immediate financial aid. Now, of course, in terms of the ethical considerations around this particular program or any program, it is up to the board of the organisation itself and the executive to make determinations about those ethics and whether or not this should apply or shouldn't apply. Of course, not all organisations will need the same financial aid. However, the program is intended to roll out fast and for the impact to be felt as soon as possible. Therefore, whether it's a business, a not-for-profit, a charity, or another type of organisation, the idea is to build the economy. I think the other thing to take into consideration when you're thinking about the ethics of applying is that at the end of the day, the program is aimed at retaining people in a working environment. And so some of that money might come to supporting people in that working environment in your organisation. Some of the money might go straight to the balance sheet and be able to be used for sustainability purposes of your organisation generally going forward. I guess the other thing to remember too is that we don't really know how the economy is going to develop or how COVID is going to develop. Things seem to be fairly positive at the moment, but we don't know what the outcome is going to be. So I do think there is a real need for boards and CEOs to consider JobKeeper in the context of future-proofing sustainability for your organisation, not necessarily that you need it immediately. But again, it's up to organisations to make that determination themselves. I guess the other thing that needs to be raised at this point as well is that, as I mentioned in my earlier remarks, there are risks and costs to participating. The risks, or rather the costs, are that staff need to be paid prior to approval and prior to funds coming from government. In other words, this program is a reimbursement program, not a funds upfront program. Organisations need to consider whether or not they apply based on how many staff they may have on their books that are traditionally paid or naturally paid less than $1,500 a fortnight, and the extent to which you as an employer need to top up those staff, because that will be the cash flow variation or difference in your organisation, if you like. Of course, if your organisation is not receiving income as a result of COVID impacts or has had a dramatic reduction, any payment to staff will also need to be reimbursed by government in terms of that $1,500. So there are cash flow implications. The other implications, as I also mentioned, were that we don't know what kind of investigations or audits will be carried out by the ATO or other government agencies. The Senate has set up a committee to look at these, the broad COVID economic responses. However, I'm fairly certain after this process, we will see further investigations undertaken. To give you an idea, the GFC was investigated by 12 separate investigations, including Auditor General investigations, and organisations were audited by the ATO post the allocation of funding and post the crisis. I think it's in the best interest of organisations, as I said before, to develop a set of principles demonstrating their decision making and documenting their rationale against being audited at some point in the future. I'll come back to the audit issue shortly. But let's talk about the scheme itself. And again, probably many people in this webinar would be well aware of the scheme generally, the general outline of how it works and how eligibility particularly works. However, just to make sure we're all on the same page, employers can enrol for JobKeeper payments, amongst other things, if they are a not-for-profit and that not-for-profit organisation has experienced a 30% fall in turnover in this period compared to 2019. If you're an ACNC registered charity, then your hurdle rate is only 15% rather than 30%. In both cases, the organisation must also employ eligible staff. And I'll come back to that eligible staff issue in the not too distant future. In terms of determining whether or not you've had a 30% or a 15% fall in turnover, depending on whether you're a not-for-profit or a registered charity, essentially the first port of call is to look at your GST income between either March or April and compare that in 2020 with the same period that you experienced in 2019. So the first port of call is to look at if you lodge your BAS statement on a monthly basis, either March or April 2019, and compare that with March or April 2020, remembering to compare the same month with the in each period. However, if you have a quarterly BAS statement lodgement regime, in other words, you put your BAS statement into the ATO on a 3-monthly basis, then you compare your quarter last year, beginning in April 2019, with the projected income for your quarter beginning April 2020. Now, there are alternative tests available in relation to entitlement or eligibility, and we will come back and talk about those briefly near the end of the presentation. However, I think it's important for you to remember that it's your GSTable income. In other words, the income that relates to all of your activities except for input taxed income. Remembering too that the requirement only needs to be satisfied once, but there are ongoing monthly reporting requirements, and I'll touch on those shortly as well. It is also important to remember that the enrolment deadline for JobKeeper scheme has been extended to 31st of May, but essentially you must be starting payments to your staff effectively now in order to be able to ensure that you're getting essentially the money out the door and to be able to be reimbursed. There's some further issues that need to be touched on as well. In terms of ACNC registered charities, I mentioned before that turnover needs to fall at least 15% in order to be an eligible organisation. But also you need to remember that ACNC registered charities can elect to exclude government revenue from their JobKeeper turnover test. In other words, any government revenue, and we'll talk about the definition of government revenue shortly, can be removed in order that you are able to perhaps modify your eligibility based on all other income. Note though that this can't be revoked. In other words, once you've decided to exclude government revenue, you can't at some future point include government revenue should that fall. The other thing to remember from an ACNC registered charity perspective is donations are included if part of the normal operating income. In other words, if you regularly receive donations and rely on those donations as part of your operations, then that is also income for the purposes of evaluating your eligibility for this scheme. If you're a not-for-profit, so not a registered charity, as I mentioned before, your turnover must fall by at least 30% in order against last year in order to be eligible. The other thing that you must do though is pursue your objectives principally in Australia. Now, with regard to religious institutions, a further change was made on last Friday in respect of being able to pay religious practitioners who are not employees in order to top up their income. But note though that this doesn't apply to those that are students only. So if you have a religious organisation that also has students in your organisation, those students can't be applied in the context of this scope. International aid organisations must be endorsed under the Overseas Aid Gift Deductibility Scheme in order to be eligible. What does the scheme get you? Essentially, this is a reimbursement scheme, as I mentioned before, and it means that for each eligible employee, you are able to claim $1,500 per fortnight, providing that you've paid your employees at least $1,500 or more in their normal income. What does that mean? It means that an employee is eligible, providing at 1st of March 2020, they were Australian residents, they were over 16 unless they were students, in which case they had to be over 17 years old, were permanent full-time or part-time employees, or they were casual for more than 12 months as at the 1st of March 2020 and not permanent anywhere else. I'll come back to this issue of casual versus permanent where staff have multiple employment arrangements. Importantly, staff are eligible, or rather employers are eligible where employees actually agree to receive the allowance, and that needs to be documented through a form. So there needs to be a documented agreement from staff to accept this allowance. Now, with regard to the $1,500, if staff are paid regularly more than $1,500 or $1,500 and more, then really there won't be an impact from their income perspective. However, if staff are paid traditionally less than $1,500 a fortnight, then they will be topped up to that $1,500. This is part of that pump priming that I talked about earlier, where we're looking to put as much consumption value back into the economy, if you like. It's probably logical, but just to confirm, volunteers are not eligible employees in the context of this scheme. Okay, so what does entitlement get you? And continuing on this discussion, firstly, as I mentioned, JobKeeper payments are paid in arrears each month, and employers need to pay all eligible employees a minimum of $1,500 a fortnight. It's important to remember that that $1,500 and any top up is taxable income in the hands of the employee. And so employees may not want to participate in this scheme and to receive that top up if, for instance, they're also already accessing superannuation or they're accessing some other benefit that is impacted by the amount of income that you might receive. So it might require a top up, but employees must confirm and must document that they want that top up. Remember that payments will only be available from the date the employee was back paid, if an employee is back paid, and if let go from when they were rehired. We've got some FAQs on this issue, but essentially it means that you must be a present employee in order for this scheme to apply. So an eligible employee must be employed for the duration of the fortnight being claimed and must be paid a minimum of $1,500 for that fortnight. The first payments to eligible employees will commence in the first week of May, so they're underway now, presumably, and JobKeeper payments can be made for the period beginning 30th of March 2020, so you can back pay in relation to that. Remember also that employers will have until the 7th of the following month to meet their reporting requirements in respect of this scheme, and the ATO then has up to the 14th of the following month to pay. It's important for organisations to take these dates into account in the context of their cash flow as well, so that if you're topping up employees in the first fortnight of the month, it could be 4 or thereabouts weeks between you paying out your employee and being topped up or reimbursed by government for the amount of money that you've paid out. The other thing to remember is that it's a minimum $1,500 per fortnight per employee, as I mentioned before, and each nominated employee must be paid that amount before tax before the end of the fortnight. This can be paid by way of salaries, wages, commission, bonus or allowances, and all of the normal tax obligations apply to that staff member for that $1,500 or more based on what kind of arrangement is paid and the normal taxation arrangements associated with their employment. It's also important to remember that this may mean supplementing pay for some employees up to the threshold. So that's a cash flow issue. And I can't reinforce that enough. You need to consider how you're going to cash flow that additional amount, even if your organisation is receiving income sources and continuing to operate. For the first two fortnights, 30th March to 26th of April, this can be back paid by the employer until the 8th of May. So really, it's a very, very short time frame for organisations to make decisions about applying for eligibility and back paying at this stage of the game. Remember, in relation to traineeships, JobKeeper payment for any individual apprentice cannot be claimed if supporting apprentices and trainees payments are being paid during the same period. So the employer might need to choose which is the more appropriate program that best supports their circumstances. Okay, another area that has been quite difficult for a lot of organisations and has been changed considerably from time to time relates to the one in all in principle. In general, if you offer, you determine that you're eligible and your organisation decides to invoke this scheme, then you have to offer that opportunity for involvement to all employees in your organisation. Those that stood down may be rehired for that purpose, and I've already spoken about that. But generally, all not-for-profit eligible employees must be made an offer to participate in the scheme. As I mentioned before, they have to document that they are prepared to participate in the scheme, and they're entitled to say that they don't want to if their personal financial position means that they would be better off not participating. It is important to remember, though, that ACNC registered charities can differentiate here. So where they exclude government funding in their assessment of eligibility, as I indicated before, that was a possibility for them to do it. They're also able to not apply for those staff employed using those government funds. Now, there are some nuances around this in terms of determining which staff might be employed using government funds, but the general rule is that you need to be reasonably able to show that those staff are employed in entirety as a result of receiving those government funds. You might choose to differentiate from those staff for a number of reasons. One might be that you feel that you are double dipping and that ethically you feel that you don't want to pursue that process. The second might be that from a cash flow perspective, it is quite difficult for your organisation to top up or to continue to pay those staff. However, it is entirely up to the organisation to determine whether or not they wish to invoke that eligibility for their staff who are paid for out of government funds. In other words, there's two fundamental decisions to be made here. The first one is whether or not you use government funding as part of your eligibility calculation for your organisation. And if you determine not to, that's fine, but you might then find it useful or appropriate for your organisation to not allow those staff that are employed using those funds to participate in the scheme as well. It is up to your organisation to make that decision, of course. So the other thing to remember is that not all employees are eligible. So employees with multiple jobs or employees who do not want to be paid the allowance are not eligible employees for the purposes of this program. Employees with multiple jobs might be employed, as they often are in human services, particularly in casual roles across a number of employers. There's two basic rules here. One is that the employee is the one making the declaration when they agree to participate in the scheme, that they are only participating in the scheme that you are offering as one of their employers, that they're not actually participating with another employer. It is up to the individual staff member to make that declaration. Secondly, in the case where an employee has multiple jobs, one might be permanent, part-time, and other jobs might be casual, it is required that that employee access this program through their permanent part-time employer rather than their casual employer. If employers do not continue to pay their employees for each pay period, they will cease to qualify for the JobKeeper payment. So you need to report that each month, what payments that you're making. Okay. Just a couple of other points. In terms of annual leave and other entitlements, the general rule is for annual leave and other entitlements that everyone would continue to be paid according to their normal working hours in the case that they're topped up. So this becomes an issue where a staff member is topped up and they don't actually work extra hours or work in a higher paid role to, for want of a better term, earn that topped up payment. Staff can choose not to work extra hours and simply receive the top up payment rather as taxable income. But in the case where they don't work for that taxable income, to put it simply, they're not entitled to annual leave or other entitlements. If they do work extra hours and they agree to do that, or making up the difference between their normal hours and the receipt, the $1,500, then all of those other entitlements apply, which means that employers need to consider how much it will cost them to both top up staff, but then also ask their staff to work, so that topped up amount will be reimbursed to them, but the annual leave and other entitlements won't be reimbursed. In terms of parental leave and workers' compensation, employees are ineligible for a fortnight if they receive parental leave pay at any time during that fortnight, or if they were totally incapacitated for the fortnight and received workers' compensation throughout. So parental leave and workers' compensation essentially is not reimbursed under this scheme. What about superannuation and PAYG? Rules are being introduced to remove the superannuation guarantee from the top-up part of the supplementary payments to meet the JobKeeper $1,500 threshold. So that top-up payment that you make, where it is unearned, will not, once the Parliament agrees, attract superannuation. If, though, you ask your staff to work for that top-up amount, in other words, extra hours or different duties, then that staff member is entitled to superannuation on that amount, and therefore there are extra costs to you asking those staff members to work, and you need to take that into consideration in terms of your strategy going forward. Withholding taxes, as I said before, should occur as usual, accounting for supplemental payments as well. In terms of accrued annual and sick leave, it's a difficult question, and I think there will be some nuancing on this particular question. But essentially, from information available, there are no changes to the regular contractual accrual of annual or sick leave. If a staff member is working for the top up, so in other words, working those extra hours above their normal working time to earn that top up amount, then accrued annual and sick leave would apply. And that means that at the end of the day, there's additional cost to an organisation in going down that route. Remember though, employees can be asked but not forced to take annual leave or to work on different days or at different times. And I'll come back to that in a second. Finally, in relation to the scheme, performance of staff is also something to take into consideration. And I've mentioned, going through a number of slides over the last few minutes, that the top-up amount to bring everyone to $1,500 in the case where their normal hours don't generate $1,500 or more remuneration means that staff can either choose not to work that time and simply take that as a windfall, for want of a better term, albeit taxed, or staff can opt to, or employers can ask their staff to work extra time to earn that income. So staff can be asked to work more hours to make up for the supplementary payment, and they can be asked to undertake different roles, providing that their hourly rate is maintained. In other words, they must at least be paid their usual hourly rate or a higher rate if asked to do a job that attracts that higher rate. They can't be paid a lower rate for that topped up amount. It's also important to remember that employers can issue what is called a JobKeeper enabling direction to give employees to ask them to take up those hours, and to, providing it's reasonable and fits the scope of the organisation, to ask them to do different work. Employees must be paid their usual hourly rate, but they can reject a JED if they want to. In other words, employees must be given at least 3 days consultation before a JED is given, but employees don't have to conform to that direction. It's up to those employees. Okay, so let's have a look at some principles for the last part of this presentation before we get into some of the risks and so on. First and foremost, I think it's really important for organisations to have a sense of income. And I mentioned before that generally the starting point is the GST return for this year compared to last year, and that makes sense. However, with the way we define income and with the peculiarities, for want of a better term, of the way some revenues arrive at not-for-profits and charitable organisations in the Australian economy, I think we do need to have working definitions of these things in order for organisations to make more informed decisions around the JobKeeper program itself. So first and foremost, in terms of income, income is remunerative. That is, you receive income for providing a supply. In other words, you earn income. You have to have an entitlement to the income from having provided the supply before you can identify it as income. Many people in the webinar would be familiar with the term unearned income, and a lot of organisations use this in the case where income is received in advance, but it is not earned yet. In other words, income received in advance is a liability to the organisation. It is not an amount that the organisation has earned and can use because the supply hasn't been provided. It's important to remember that definition when you're considering what items might be or might not be income. For instance, you might have received a lump sum payment for 3 months of work on the 1st of April, and you will not complete or be entitled to all of that work until you've completed that money, until you've completed that work. The other thing to be aware of in relation to other similar COVID response programs, the cash booster payments are non-taxable and exempt. You might place these funds directly in a reserve or investment directly without going through the P&L. And so for the purposes of defining income for your organisation, cash booster payments shouldn't be taken into account. The other difficulty we often have is working out whether something is government income or not, and particularly more lately as governments have used what we call quasi-economic funding arrangements, so where they've used market funding arrangements to provide funding to organisations, and where choice and control of consumers is a major component of the particular program. So NDIS, for instance, is a great example, but so is consumer-directed care in aged care. First and foremost, government income must be received and earned from a government or a government agency. These can be Commonwealth, states, territories, local governments, or the United Nations. Secondly, government agencies are defined as, or might be recognised, where you can see that that government agency was established via legislation, where it's subject to public sector governance legislation, subject to ministerial direction, is an agent of the Crown, maybe that there's a specific cause in its establishment legislation removing tax obligations, or the Auditor General audits that organisation. All of those elements are clues that an organisation is a government agency. And of course, if the agency has a minister, I think that also is very, very strong indication of that agency's public sector status. On the other hand, grey areas can still exist. So in the case of things like the NDIS or CDC in aged care, I think there are further questions for organisations to consider in determining whether or not particular income streams are government or not. First of all, I think it's important to consider who negotiates or sets the price. Who do you invoice for your payment, and also who sets the administrative and funding structures, and who pays. I think they're all questions to be asking in the context of trying to determine whether a particular program of funding that you receive is in fact government income. Ultimately, it's up to organisations to make this determination. And as I mentioned before, it's really important for you to document how you've arrived at the decision that you've arrived at. However, I think it really is important to remember that accounting principles also still apply. So in the case of payments such as that made by NDIS recently, where payments were made in advance, well, those payments are unearned by definition. They're unearned by definition because if you spend them on cash flow now, you still have an obligation to provide that service at some point in the future, and therefore it's not income until it is earned in the provision of that particular service. Grant income is another area where people have often asked whether or not this is income for the purposes of the program. It's important because to recognise that we often term income streams as grant income through what might be termed custom and practice, rather than looking at the correct definition of grants, if you like. And therefore, I've tried to break this down to look at what I think are two fundamental types of grants organisations can have. They are income grants or asset-related grants. In the terms of income grants, an income grant is a grant received by an organisation in consideration of a supply. So in other words, it is money that comes in and is earned by the provision of a service or the provision of a good to government in response to receipt of that money. So received as income in consideration of a supply means that for that grant to be identified as income, you have to have earned it. It can't be unearned income. It's important to remember, though, that those grants might relate to normal trading activities, in which case, providing they're earned, they are income, but also increasingly, such as in Western Australia, Lottery West is providing sustainability payments to organisations, as are many philanthropists and others around the country, then those sustainability payments are also income for the purposes of this grant. Based on the Australian accounting standards, income grants and asset-related grants are, I think, really good way to consider the source of your income and whether it applies. In asset-related grants, an organisation would receive and be paid onto a third party. Government's asset-related grants typically relate to things like the purchases of buses or the building of buildings and so on. And in the case of asset-related grants, the recognition of income is generally identified when over the life of the asset as the asset is consumed. So in terms of income grants, we invoke the profit and loss when the supply is provided or when a sustainability payment is made. In other words, it's income at that point. With asset grants, though, even though you might today receive $10 million for the building of a building, in fact, you don't recognise the income for that $10 million immediately. That income is recognised over the life of that asset as you consume the building. Therefore, $10 million paid up front for the purchase of a building or a building to build a building is actually unearned income or a liability on your balance sheet. Turnover is also an important thing to consider, and as we mentioned before, turnover is focused on the current calculation for GST purposes, but there are a couple of things that need to be considered there. First and foremost, ACNC registered charities only need to include tax-deductible donations received by a deductible gift recipient, and if not a DRG, gifts of monies, property under greater than 5,000, including listed shares, can be included. You can opt, though, to exclude supplies made to government agencies or to a UN, as we've said, a UN agency, as we've said before. There are, as I mentioned, alternative tests available, and these relate to special purpose types of organisations or new organisations that have not been trading for a year and so can't compare this year's with last year's income. There are links at the end of this webinar to help those gain information in relation to these alternative tests if you need them. Okay, so the final substantive point I'd like to make relates to risk considerations and documentation particularly. Remembering that the government's trying to stimulate the economy by giving out money with limited restrictions is a really important consideration, but it's also important to remember that after the virus has been contained and things get back to normal, so to speak, then government will be looking to pay for what has cost in excess of $300 billion up to this point in time. If that's the case, then government will traditionally look to organisations that it feels hasn't been eligible for programs that organisation has accessed, and in that case it will be necessary for organisations to pay back any amounts that were inappropriately paid. Therefore, you need to take this decision make this decision very, very wisely to ensure that you're not building into your future a cash flow problem associated with having to reimburse government for things that you might not have been entitled to. The other thing is to be aware of is that the Fair Work Commission is arbitrating any disputes that come out of things like JobKeeper enabling directions or any other disputes that might arise as a result of this program. Anecdotally, we're hearing that one thing that Fair Work Commission is looking at is disputes essentially between employers and employees, where one employee is alleging another employee is getting a better deal in terms of working hours or responsibilities in the context of top-up payments. So you need to be documenting not just the rudiments of your decisions around this particular scheme, but you may need to document why and how you go about deciding to allocate tasks to employees who are prepared to work for their top-up amount. So documenting all decisions, including how you got there, is absolutely incredibly important. The final point on this slide I think is worth noting is that we don't know what kind of post-investigation processes government will enter into, but government has on all its websites a warning similar to that in italics on this slide. That is, if there is a significant difference between your projected turnover and what eventuates, we may need to assess whether your assessment was reasonable. So you need to keep good records of your calculations. Okay, proof of income drop according to the rules has been discussed earlier. But if working out likely sales, so in other words, trying to forecast, remember you need a reasonable estimate. So you need to document the proof that you use to be able to approach that. If electing to exclude government revenue, you need to complete a form by this Friday, that's tomorrow unfortunately, in order to inform Treasury accordingly. Keeping records of previous earnings for the same month or quarter is obviously absolutely critical, and considering changes in your accounting practices is also something to consider. So that if you traditionally use cash accounting for your organisation, but you determine to go to accrual accounting in order to take into account unearned income for the purpose of this scheme, I think it's really critical that you continue to use those practices well after the JobKeeper scheme has been wound up. The JobKeeper employee nomination notice forms for all eligible employees must be filled in and completed within 7 days of enrolment. If you don't do this, you will be subject to a $4,200 fine per instance of not having that form. So you must make sure the paperwork is absolutely tip-top and that you're following up everything within the time frame. I guess that's another thing to consider in terms of the number of staff you might have, and that might be a determining factor as well in the context of whether or not your organisation actually applies for the JobKeeper arrangements, notwithstanding your relative eligibility. JEDs must be in writing, as indicated before, signed and dated by employees, and they must have agreed to that JED 3 days before the implementation, unless the employee agrees to waive that 3 days. Remembering that you must document all of these things, and you must have the employee sign that document in order to have proof down the track that you've done the right thing. Okay, so ongoing reporting requirements. I mentioned before that you need to report on a monthly basis. That doesn't mean that you are continuing to reconfirm eligibility, but it does mean that you need to continue to let the government know how much you're paying and who you're paying, so that they can see what eligibility there is there, but also they would use that aggregate information to determine the continuation or otherwise of the JobKeeper program itself. Okay, just a few FAQs before we get into question time, and I know we're running out of time. First and foremost, what if we no longer meet the requirements? Do we have to step out of the system? As I mentioned just a minute ago, no, eligibility only needs to be proven once, but monthly income must be reported after that point. What happens if staff get paid the allowance via different organisations, and to what extent do employers need to inform themselves? It's up to the employee to nominate one primary employer. Employers should be aware of the casual staff who have permanent employment elsewhere will have to use that employer for JobKeeper purposes, and employers should consider, with their knowledge of their staff, where they think there might be issues in relation to double dipping. But at the end of the day, it's up to the employee to make that declaration. And then do employees receiving the allowance have to go to work? Well, essentially this payment is designed to supplement or to provide people with income in order to allow them to navigate their bills and what have you, consumption over the course of the virus. And in the case where organisations are no longer operating as a result of the COVID lockdown, then those staff don't need to go to work. Eligible employees must be employed, and payment is only from the fortnight they were re-engaged in the case of reinstatement, but they don't have to work for that top up particularly. And I think the jury's out on whether they have to work in relation to their normal hours. However, we will try and get information on that as it comes to hand. Okay, so what post-COVID-19 assurance activities is government looking to undertake? As I've said before, we don't know, but they have been foreshadowed by government, and you should take those into consideration. Further resources are available, as I said before. I won't go into these now, but do avail yourself of these resources. And our contact details are also available for you to use should you find that you would like to communicate with us, either in terms of issues you might have, but also in terms of any problems or ideas you have for how we might approach this training process more effectively. Thank you, and I'll hand back now for questions.
Yeah, g'day. So we've had well over 60 questions, and please bear with us. We will get to the questions later, if not during the session. I'll start with, there's one that's got a lot of people liking it. Government funding versus government grants. The law companion ruling only excludes government grants from turnover test. Unsure if we can therefore exclude, for example, our funding from the Department of Health. And can I just point out, the law companion ruling doesn't include the amendments that came out on Friday. So it doesn't actually talk about ACNC allowing to exclude government grants. So yeah, sorry.
I was just going to say, one of the things that we're doing over the next 24 hours is we've been compiling a FAQ and answer document, and we'll certainly respond. I think it's more important that we respond to that particular question through the FAQ process, because there are so many nuances to it. It's hard to deal with that in this situation with such a limited amount of time, but we will deal with it through that FAQ process, and we'll distribute that FAQ document tomorrow.
Another one is my organisation's eligibility feels entirely fortuitous based on the timing of the grants received. Received in March for funds used over the year. This makes us eligible despite not having overall downturn in revenue. Am I missing something?
So depending on how your organisation accounts, if you go back to my comments around the principles that you should apply, then you need to consider how much of that income was earned during the month of April, what will likely be earned in the month of May, and so on. In other words, a great proportion of that amount of money provided is, in accounting terms, unearned income, and therefore would not be taken into account necessarily by your organisation. But you need to get audit advice or accounting advice on that for your particular organisation. But the unearned income rule likely applies in that case.
What if the forecast turnover is below actualised turnover by the end of June, so a drop less than 15%, for example?
Yep, so you should be watching that on a monthly basis, and probably watching that more closely as you're going along, and you can opt out of the scheme depending on your organisation's perspective of whether or not you should be in it. And that is something that you need to watch closely, and watch how your organisation actually responds in the context of forecasts you've made for income going forward.
And can I just add to that, if you show the calculations, if you can show the calculations that it was projected that you were going to fall below 15%, then that should be adequate. It's only if the calculations are very much, they seem to the ATO to be untrue or unreasonable.
I think that's a really important comment, Tom. The rules talk about reasonable expectations, and that's why documentation is absolutely important. But if, for instance, you had a letter today that said in 2 months you're going to get $1 million, and you know, all things being equal, you didn't take that into consideration in terms of eligibility, then that could be considered, that kind of thing could be construed as unreasonable. So if you fall by 14% rather than 15%. And I don't, I'm not suggesting that's the kind of parameter you're looking at. You need to be able to argue the reasonableness of your case. So how did you come up with those forecasts, and why are those forecasts reasonable?
Our overall business revenue has increased. However, we have a variety of funding buckets that relate to specific services. I have 2 services that are now experiencing a decrease, and employees working within these services are at risk. They cannot be utilized in the area that we have increased funding. Is there a way that I can reflect the situation in order to claim JobKeeper?
That's another one that we're quite happy to refer to the FAQ. All things being equal, if your organisation's not eligible, but there are divisions in your organisation that were they standalone organisations would be, then there's no eligibility there. So you've got to be an eligible organisation rather than have eligible portions of your organisation, if you like. Again, this is part of or rather should be considered in the context of my comments right at the very start of the presentation, where I said, the whole idea here is to get as much money out as possible, and those nuances just simply haven't been taken into consideration. So what government might be expecting, for instance, and I'm not suggesting that this is right or that you should act on this in any way, but the government might be expecting that if you're making profits, for want of a better term, in other divisions in your organisation, then you need to allocate funds to keep your poorer performing parts of the organisation sustainable in the short term.
If we claim JobKeeper in wrong, can we ask the employee to return the overpayment?
This is something that we're still doing some work on, but generally speaking, my suspicion is that the normal rules, so to speak, of employment apply, and you can't ask for that reimbursement from the employee.
Just to add to that, Fair Work Australia has amended some rules, and they are very strongly cracking down on things like not passing JobKeeper employment on
yeah,
trying to avoid things like that.
Yeah.
What happens if my employee does not consent until mid-May?
If your employee doesn't consent, then they're not an eligible employee for the purpose of the JobKeeper scheme. And so you can't be paying particularly top-ups to employees if they haven't consented to participate.
And it's worth also mentioning to keep any records or documents to show that you have actually offered it to the employee.
Absolutely. So timeframes are critically important. And indeed, as I mentioned a little earlier, the administrative aspect of this might also be a consideration for organisations where you employ a lot of people. But Tom's absolutely right. You've got to make sure that if you offer me or you offer the scheme to me, so to speak, and I don't get back to you with the paperwork for 2 months, then you've got to document on my file when you offered, when you followed up. So don't just leave it go lame. And if the form hasn't come back, you can't make the payment. Remembering too that there's sort of 2 aspects to the transaction, for want of a better term. One aspect is that the government will reimburse you or pay you $1,500 per eligible employee, all things being considered. On the other hand, you don't necessarily pay employees anything more unless those employees earn less than $1,500. Then you just continue to operate, but you're entitled to claim $1,500 for those employees that are eligible.
Great. It's past now. So I'll just ask one more really quick one. My turnover won't decrease until July 2020. What do I choose as my comparison?
You choose the month April or May. No, sorry, March or April 2020 with March or April 2019. So what happens in July, June, July? We don't know even if JobKeeper will still be going then. Because at the end of the day, this is a response to a particular situation. It does seem in Australia, from what I can tell, that the situation is more favourable than perhaps people expected. But at the end of the day, it's quite clear that you need to compare your income in March or April this year with your income in March or April 2019. That's the eligibility criteria.
Great. I think I'll leave it there for now.
Thank you, Tom. Thank you.
Okay, I might just, did you want to say anything else to wrap up?
Only that obviously we're really keen to get questions through, but also comments about, so some people have sent through some intelligence that they've gathered or some discussions that they've had. It helps us with the context. We're working really hard trying to refine things as things come out, but with the sector's help, we can hopefully get better information returned back to the sector as well.
Absolutely. And a couple of things I just want to wrap up. I saw lots of questions coming through the screen around, are we going to get a copy of the slides? Will we get a copy of the slides? The answer to that is yes. We'll definitely make those slides available to everyone, and feel free to disseminate that to a whole lot of participants who weren't able to come today. I want to once again thank you, Professor Gilchrist, for the amount of work that you've put in to make this specific to NFPs, because there's been a lot of questions, and I think the way it's been set out has been really clear and well structured. And I also want to thank you, Tom, Emery, for the support you've provided in terms of being the research fellow, and I assume that you've had quite a bit of input. In relation to the fact that I've just read that there are 62 comments and questions, would it be fair for me to say that you'll be able to have a look at those questions and see any themes and put those in the Q&A that you'll be able to distribute tomorrow?
Absolutely. So the Q&A is themed, and what we do is we look at all the questions. As you can imagine, out of those 60 odd questions, there'll be a lot of repetition, albeit asked different ways. And so we essentially go through those and look at them in the context of themes, and then we're trying to get the FAQ questions down to much more manageable number. So I think we had 4 or 5 pages a little while ago. We're trying to get that down to a couple of pages so that people can navigate it much more easily.
Great. All right. I'll take this opportunity to make sure that we finish on time. Thanks again to all the participants for coming, and thank you to ACOSS for assisting us with the technology today. And we look forward to making this available to many of you across the sector. Thank you.
Thank you very much.